Reversals, both upward and downward, can often mark a change in trend. Reversals are a way large funds are forced to expose their hand and can often create a low-risk opportunity to buy or sell shares of a stock. What's up, everyone? Today we're going to be going over reversal bars and why they are one of my favorite strategies to get you into or out of a stock. I've got a link in the description for a free indicator to help you spot them, but before we get started, make sure you hit that like and subscribe button so you don't miss one of my videos. So let's start off by reviewing what defines a reversal bar. For this, I personally like to use the Investor's Business Daily definition. They define an upside reversal as the current bar undercuts the previous bar and then price rallies and closes in the upper 60% of the range. They define a downside reversal as the current bar makes a high above the previous bar and then sells off and closes in the lower 60% of the range. So now that we have a general understanding of what reversal bars are, let's talk about when you want to use them. First, let's talk about the upside reversal. When looking for a reversal bar, it's very important to consider the overall trend of the stock. The reversal should only be taken in the direction of the trend. For example, if the overall trend of a stock is up, you'll be looking for an upside reversal bar, not a downside reversal bar. The next thing to consider is the level at which the reversal bar forms. This should ideally be at a level of support where price is likely to bounce and continue in the direction of trend. This could be a moving average like the 21 exponential moving average, the 50-day or the 10-week simple moving average. It could also be at a prior pivot area or an earnings gap up high volume close or the low of that day. The important thing is it takes place at a possible area of support on the chart. Switching over now to a downside reversal bar, you need to first evaluate where the stock is in its life cycle. Has the stock already experienced a significant move, or is it just emerging now from a new first or second stage base? You should also consider how far extended price is from its moving averages, as well as any potential psychological levels, such as the Livermore 100 level. Now that we've discussed what reversal bars are and when you should use them, let's go ahead and take a look at some specific examples to help illustrate these concepts. We'll start with an upside reversal bar using Mosaic from the beginning of 2022. As you can see, Mosaic had formed a nice cup base and broke out into new highs. However, the stock sold off quickly before finding support and forming an upside reversal bar right at its 10-week and 50-day moving averages. It closed at the 92nd percentile of the daily range, which is identified on the chart with the purple label. That label is part of the indicator I created to help spot these reversal bars. There'll be a link in the description for that, and I'll discuss more about that later, but first, let's keep going through this example. One thing I love about reversal bars is they make it very easy to define your entry and your exit. A move above the high would trigger an entry, and our stop would go just below the day's low. The next day, you can see Mosaic opens up right at that 10-week moving average and then throughout the day pushes higher and triggers our long entry. Fast forward a few weeks and you could have been sitting with a very healthy gain, all while keeping your risk in check and your stop was never tested. You had a few more upside reversals that happened on the way up as well. The first one would have stopped you out. However, that same bar turned into an upside reversal that would have turned into a great trade as Mosaic did go on to make much higher prices. So now that we've looked at an example of an upside reversal, let's go ahead now and look at a downside reversal using Apps from March of 2021. Apps had a very good run in 2020, going from the low single digits to nearly $100, but in 2021, as many growth stocks began to peak, so did Apps as it failed right near the $100 Livermore level. It staged a downside reversal, closing at only 5% of the daily range. If we take a closer look at the downside reversal bar, you can see price had become extended from its moving averages and volume had also increased, showing institutional selling. So unlike the upside reversal bar, where our entry triggers as price moves above the upside reversal bar, with a downside reversal bar, our trigger is when price breaks below the downside reversal bar. When that happens, it's your clue to either sell your existing shares that you owned and lock in profit, or if you thought this stock or the market was topping, you could go ahead and go short. The next day, Apps breaks lower and triggers our sale. The selling continued as this dropped all the way back down to almost $60 in a matter of days. Again, let's fast forward and you can see that selling at that downside reversal would have saved you from sitting through a nearly 50% decline, and you were actually able to sell just a few percent below the all-time high. So reversal bars are a powerful tool to help identify potential changes or continuation in a trend. They can provide clues as to what institutions are doing with a stock and allow for low-risk entry points or great spots to lock in profit. To help make spotting reversal bars easy, I created an indicator for TradingView. It'll plot a label below an upside reversal bar that shows the daily closing range just like this. It'll also plot a label above a downside reversal bar that also shows the closing range, just like we saw in that apps example. So make sure you click the link in the description to add that to your charts. Thank you for watching, and if you enjoyed this video or found any of this information useful, please go ahead and hit that like and subscribe button to stay up to date with all my videos.